All right, let's dive into a strategy that's all about cutting through the chaos of the stock market. It's a philosophy that has guided some of the smartest investors in the world. We're talking about value investing, the brainchild of the one and only Benjamin Graham. So, what's it all about? How does it actually work? Let's find out.
Okay, first things first, let's ask a really basic question. When you click that buy button on a stock, what is it that you're really getting? Is it just a ticker symbol bouncing around on a screen? A little digital blip that you hope goes up? Well, if you ask a value investor, they tell you absolutely not.
And that brings us to the core conflict in all of investing. On one side, you've got the price. That's the day-to-day noise, right? It's the number that's driven by emotion, by hype, by whatever the news is shouting about that day. But on the other side, you have value, and that's completely different. That's what the business itself is actually fundamentally worth, based on real things like its performance, its assets, and how much money it's likely to make in the future. The key thing to get, and this is everything, is that these two numbers, they are very, very often not the same.
And that difference? That's exactly what Benjamin Graham's whole philosophy is designed to take advantage of. The game here isn't to ride the wild waves of market hype. No way. The goal is to build long-term success by completely ignoring the temporary booms and the inevitable busts. You focus only on a company's true underlying value. It's how you keep your head while everyone else is getting swept up in the market's emotional roller coaster. Okay, that sounds pretty good in theory, doesn't it? But how do you actually do it? How do you tune out that noisy market price and figure out what a company is really worth? Well, value investors have a specific process for this. It's time to open up the Analyst Toolkit. And the main tool in that kit is something called fundamental analysis. So forget about all the complicated charts and squiggly lines for a second. This is all about putting on your business owner hat and doing some real detective work. It means you're digging into the company itself, its financial health, its management, its position in the economy, to figure out what it's genuinely worth. And conceptually, Graham boiled this all down to a pretty straightforward formula. A company's value is, roughly, its forecasted earnings, so what we expect it to make, times this thing called a capitalization factor. Now, trying to predict earnings is one piece of the puzzle, for sure, but the real secret ingredient here, the whole key, is that capitalization factor.
So what on earth is that factor? How do you figure it out? Well, it's not just some simple number you can look up. Think of it more like a final score, a judgment call you make after you've played the role of a business detective.
So to figure out that all-important capitalization factor, your investigation has to follow 5 key clues about the business you're looking at. Let's break them down.
First up, growth prospects. Is this company going places? Is it in an industry that's actually growing? If the answer is a big yes, you'd be willing to pay more for its future. Second, management quality. Who's running the show? Are they smart? Are they trustworthy? Because great leaders create so much more value. Third, financial strength. Is its balance sheet rock solid? A company that can survive tough times is way less risky and, because of that, more valuable. And finally, you look at its dividend record and rate. Does it have a history of sharing its profits with shareholders? A steady dividend is a really good sign of a healthy, stable business. So you see, the better the answers to these questions, the higher your capitalization factor will be, and the more that business is worth.
Okay, so we've got our checklist of clues, but, a detective is only as good as their evidence. Where do you actually go to find the answers to all these important questions?
The evidence you need is all right there, inside the company's own financials. This is the detective's dossier. You're poring over things like annual reports and cash flow statements. You're looking at key metrics like EBITDA, which is really just a quick way to gauge a company's overall performance. You're also paying attention to what the company's own leaders are forecasting and digging into its track record. This is where you find the cold, hard facts. And this table here, it just pulls it all together perfectly. You see how it connects? If you want to investigate a company's financial strength, the evidence is waiting for you in those annual reports and cash flow statements. If you're trying to figure out its growth prospects and management quality, you look at what the executives are saying and what the performance records show. The clues on the left tell you exactly where to look for the evidence on the right.
So look, if you take just one thing away from all of this, let it be this. The heart of value investing is really a change in your mindset. You are not just buying a ticker symbol. You are buying a piece of an actual living, breathing business, and you have to start thinking like a business owner.
And that leaves us with one last really important thought. Doing all this homework to figure out what a company is truly worth, that's only half the battle. The second half, and maybe the much, much harder part,
is having the discipline and the patience to just wait until the market gets irrational and offers you that great business at a price that's less than what you know it's worth. So maybe the real challenge of being a value investor isn't the analysis, but the waiting? Something to think about.